Good morning, everyone. This is Andre Labuschagne from Aeris Resources. I'm the Executive Chairman, and I want to give you an update today on the transformational transaction we're busy doing, and then a bit about how the company is going to look post this transaction. We are buying the Krakow gold mine from Evolution. It is a highly cash-generating asset. It's got a huge upside on exploration. There's a lot of synergies we'll extract, and I'll talk you through those. But really for us, it is something which we've been looking for a long time, and we'll be looking for how do we extract value from this, and then looking at setting the company up for the future. These are just the normal compliance statements. The transaction summary, so as I said, we're buying the Krakow gold mine from Evolution. We're paying them $60 million cash up front on completion, which would be on the 1st of July. A deferred cash component of $15 million by the end of year 2, and then a 10% net value royalty. And net value royalty is defined as the revenue less C1 cash costs, and 10% of that would be the royalty. It starts in year 3 and it only goes for 5 years, and it's capped at $50 million. To put it in context, to pay them $50 million, we'd have to make $500 million. So it's a significant return for us before we pay that sort of dollars to Evolution. A bit about Krakow. It's been going for over 15 years. It's always replaced its reserves, and I'll show you a slide on that. And we're forecasting for FY21 between 70 and 75,000 ounces of gold at a C1 cash cost of $980 an ounce. What we will do, though, we will kick off a very aggressive exploration plan for especially the first 2 years. We allocated $13 million to that, and that's just making sure we can bring some of the unclassified material into resources, and then also extend the current reserve position of the company very quickly. The rationale for the deal, it's a highly cash generative asset. It will generate about $115 million of the first 2 years of its life. This is the right skill sets for us. It's small enough. It fits our strategy. The synergies we can extract is significant, and it also allows us to utilize our $256 million in tax losses, which currently sits at the Aeris level. The funding side of it, we are busy with a $40 million equity raise, which will be completed by the end of the month. 30 million of that will go towards the acquisition, and then we got a $30 million acquisition bridge facility from PAG, which is one of our major shareholders, for the other $30 million, and that will be repaid within the first 12 months. We had really good support from our 3 major shareholders. They all followed their money. PAG will, though, dilute down to 19.9%, and that's all to do with managing a proper register with no major shareholder above 20%. We'll go through the financial operating impact on future slides, but as you can see on that slide, it generates significant cash. It's really good change in EBITDA, and very quickly you'll go from a net debt of $77 million to $47 million in 12 months. The transaction highlights, it is consistent with our strategy. Always said we're looking for copper and gold. We always said we're looking to grow the business to bring in more assets into the portfolio, and it really just ticked all the boxes, and it's an exceptionally strong fit for us. It's gold. Location is 5-hour drive from Brisbane, where we got our corporate office. It's the right size, a lot of potential further upside, and we believe it's a perfect fit for us to take this in and generate a lot longer life out of this, and create a platform for Aeris to grow the business further. Bit of history, there you can see the next 2 years, but you look at the history, it always generated between 80 and $90 million of ounces of gold. This year they're forecasting 82 to 87, and we're forecasting 70 to 75 in the year thereafter. They consistently over a long period of time always over reconciled and always generate additional 10 to 25% additional ounces from what they plan to mine to what they actually get, and we don't see a reason for that to change. Looking at cash flow slide, you can see they historically always generated cash. The high price they getting the benefit of the high price now in this financial year, and you can see there we're forecasting around 68 and $47 million for the next 2 years from the Cracow mine. This is a important slide to have a look at, and you can see there the history. They never had more than 3 to 4 years of reserve life at Cracow, and has always managed to replace what they mine, and has always managed to extend the mine life beyond the current three years in reserve. We don't see reason for that to change. We will, through the $13 million exploration program, we will ensure that we will keep the focus on exploration and keep the focus on converting unclassified material into resource and reserves, and look at the exploration upside for the mine. So the plan for Aeris, firstly, it's a smooth transition of the mine into the Aeris portfolio, would be the priority, ensuring that the cash flow which we're focusing on would be achieved. And as part of that, we will put a hedge in place for some of the ounces to ensure we can lock in some of the high gold price we see today. The $13 million in drilling and the near mine exploration would be the main focus. We'll kick that off on day one. And you can see there in the medium term, there's a whole list of opportunities, and those are only 6 or probably 15 different projects which we will focus on to actually grow the mine beyond 3, 4, 5 years. There's 903 square kilometers of ground, very highly prospective New England Fold Belt, and that in itself is an opportunity for further greenfields exploration, but also there's quite a few explorers in the region, and we do see the opportunity to talk to some of them in also further to see how we grow the region and look at the consolidation of the region around Cracow. So how does Aeris look post the deal? We will have the Cracow mine in Queensland. We'll have the Tritton mine in New South Wales. We'll have a footprint on the east coast of Australia, which we do see as an opportunity to look at further opportunities to grow the business. But looking on the right-hand side, so it's about a 50-50 gold and copper production, EBITDA of about $282 million over the first 2 years, and a cash flow of $155 million over the first 2 years. By the end of year one, net debt to EBITDA would be around 0.5, and by the end of year two, it probably would be around about 0.3. So a significant and fast improvement on the balance sheet of the company as we bring this into play. What this, of course, also allows us is to get full value out of both these mines, specifically focus on smart capital investments by extending the mine life at both these mines with the opportunity and the ability which we'll have by using the cash from the business. A bit about Tritton. So Tritton has been a consistent producer over the last 8 years since we got involved as a management team. The team at the mine has done an amazing job to turn the mine around from a negative cash flow in 2012 to a positive cash flow, and took the production up all the way to 30,000 tons of copper. There's a 1.8 million per annum process plant. We typically mine 2 underground mines. We're currently mining the Tritton and Murrawambi mine, and those to deliver about 1.7 million tons to the process plant, delivering 24,500 tons of copper. So Tritton currently has got a 4-year mine life or mine plan. There's still 6.7 million tons in reserves. There's 19 million tons in resource. The 4-year plan basically just take into account mining of Tritton and Murrawambi, plus 2 open pits. The further extension opportunities lies within Tritton and Murrawambi. Both extends further depth, and in fact, Murrawambi has been a great asset for us in the fact that, you know, when we started off, it was to be mined at 0.3% copper. It's currently mining nearly 2% copper. So that's been a great story for us. And you've got Avoca Tank and Budgery deposits, which is currently not in that 4-year plan, which you can bring on board. Budgery Guard to form part of that. So there's a whole list of opportunities which we can further extend that mine life beyond 4 years. If you look at the right-hand side where you see that map, all the discovery so far has been in the southern part of that tenement package. The northern part hasn't been explored much, and we have moved our focus to exploration in that northern part of the tenement package to see how we can extend and what other potential ore bodies sits in that northern part of the package. So in summary, we do think this is a highly compelling investment opportunity. It's a right mine, it's very attractive. It fits in with where we want to go with the business, and it does put us as a diversified producer, and we will generate free cash. The management team has a proven record of fixing mines up and taking things forward. We see this fit neatly into our skill sets, and really it resets the platform for us to look at further growth and really look at how do we extract full value from Tritton and Krakow, and then set us up for M&A opportunities. I think that, thank you very much. I would refer you to the announcement which we made on the 4th of June about the transaction for a bit more detail. The presentation is on there. Please feel free to have a look, and looking forward to show you in a month or two how we progress with this acquisition. Thank you very much.